Tom Nelson, we've seen a lot of volatility so far in this very young year. So how does this affect target date funds? Because those are long-term investments.
Yeah, so as you mentioned, target date funds tend to be long-term investments. The great things about them are that they keep investors diversified across asset classes and markets and regions and countries and styles and sectors. They do also help to keep investors in the market. And so while we've seen a lot of volatility in the first few weeks of 2015, and our view is that there will be more volatility this year than we've seen in the last couple of years. Target date funds help investors to really stay the course through thick and thin throughout their pre-retirement years.
And how do you find yield for these target date funds when yields just keep going down? I mean, this great bull market in bonds just keeps going on.
Yeah, it's been fairly difficult. With rates, where interest rates are where they are today, they are extremely low versus what we've seen historically, and you really have to deal with the trade-off between striving for yield and what really comes with that is additional risk. And so you really have to today take on a lot more risk in order to get the kinds of yields that people are expected to be taking in the past. For us, we're multi-asset portfolio managers, and so we can move across different asset classes, get diversification, but the way that we're talking to investors today is to not necessarily expect the types of yields that they're accustomed to in the past.
And would you say that your funds are more or less aggressive than target date retirement funds at some other shops?
So we tend to be on the more conservative end. There's a spectrum, and really two camps can kind of dictate whether or not funds tend to be a little bit more conservative or a little bit more aggressive. And that's with that target date fund glide path and whether or not the asset allocation ends at retirement, and that's the to retirement camp, or through retirement, which tends to evolve the asset allocation for 5, 10, in some cases 15 years beyond retirement. And so the through retirement managers, all else being equal, tend to be more aggressive, and the to retirement managers tend to, all else being equal, be less aggressive or more conservative. And we're in the to retirement camp, the more conservative camp.
And how are you allocating between foreign and domestic stocks? Because we're seeing a wide range of growth globally when it comes to the European economy versus the US economy versus Japan versus China. So how do you mix it up in your target date funds?
Yeah, so good question. We have a global investment committee that meets multiple times per week and talks about where we see opportunities and risks around the globe and across asset classes. Where we sit today, we think that the US economy is in fairly good shape, and we're to the point where we're starting to see the seeds of the accommodation being taken off the table and the possibility of rising interest rates via the Federal Reserve this year. We've had a 6-year bull market in equities in the US. We think it's a little bit long in the tooth. US equities are a little bit more expensive, although not overly expensive, but more expensive than other regions. We feel that Europe today, for example, kind of feels like the US a couple of years ago. And if you look over time, just from a monetary policy standpoint, when the ECB is more accommodative than the US, 2/3 of the time historically, on a go-forward basis, European equity market returns have been better than what we've seen in the US. And so we're leaning our portfolios a little bit more towards Europe today.
All right. Thanks a lot, Tom.
Sure. Thank you.
And thank you for watching The Street.